A lot of what we experienced in GameStop, we are kind of hoping to create a platform that can enable that sort of crowdsourcing of knowledge. That brand still has a lot more value than the market is ascribing to it today. It's just crazy to see, life was a meme at that point. I had a sell order of 420 shares fill at 420.69 while I was on my favorite podcast. Like, you can't make this stuff up. It was crazy.
Hey, welcome to this edition of the Raz Report. Very excited to have a longtime friend who we met in the GameStop era online, Rod Alzmann, founder of GMEDD.com and managing director of Wook Capital. How are you, man?
Doing great, Jason. Glad to be back.
Yeah, so I met you at interesting times, okay? This was the GameStop craziness where, and I've seen the show on Netflix, like Eat the Rich, and me and Luke are on the show because when we first had Andrew Leff on the show, this was the beginning of the whole GameStop stuff. We had Andrew Leff on the show, and what happened was all the Wall Street bettors came to our channel and were like calling us boomers, that we didn't own GameStop, we didn't understand it, and so they were all going crazy at us, and so by the end of the show or middle of the show, Luke bought shares of it, and then I bought shares because if you look at the thumbs up, thumbs down, this is not the right feed right here, but the thumbs up, thumbs down, we were getting 1 million thumbs down because we had Andrew Leff on, and he was negative GameStop, so people were killing him. And then we bought the stock, and then they loved us. And there's a show on Netflix that we're on, and this whole clip is on the Netflix show. And this was when Andrew Leff came on, and then there was a couple other times we had you on. Hold on, let me go back to this feed here, and I go to share my screen. 1 second.
It was crazy when you guys had me on. The stock got halted like a half dozen or so times.
Yeah, and this was. I don't know if this is the one. If this is the one we had you on, because we had you on. Yes, this is when the show you were on. The stock kept getting halted, and you had thousands and thousands of people in here talking with you, and we were the room where it happened that day. Like it was absolutely insane, and it was just like another era. Oh, there you are. See, Rod. See, GameStop provides update, and that's you. I don't know if you see it on the screen right now, right? I think you see it. And it kept getting halted, then going, and it was just look at that right there. See, 260. This is during. Oh my god. Okay, so then
if you stay there for a second, if you stay there on that chart for a second,
I'm gonna go back to it. 1 sec. Sorry.
I mean, it's still just crazy to think about how that few weeks in January transpired. I was hoping you could show that chart, though, to kind of point out where the stock was, and I can kind of call out a few events.
Yeah, please.
I don't know if you can make a max screen so folks can see the dates a little easier. On the left, it looks like the 10th or 11th, because Ryan Cohen had settled with GameStop's board of directors on the news came out on a Monday morning, and I think the stock went up a little bit. This is pre-split. Remember, the stock has now undergone a 4-to-1 split, so all the current prices reflect that split. But at the time, it was trading in the high teens. I think after the Cohen settlement that Monday, it closed up. I don't know, maybe it was like 10%, and it closed around $18, $19, $20. But it wasn't until that Wednesday where the stock doubled. I think it was Wednesday the 13th of January. Or 14th of January. And as I understand it, that's when one of the large short hedge funds had covered at that point in time. So you got the Cohen settlement. You had 2 days. You had Monday and Tuesday where the stock didn't really rocket. But then that Wednesday is when it began to take off. Then I think it was a day or two later that Andrew came out and said, no, back to 20 fast. I'm going to come out with my own report. That following weekend was the Martin Luther King Day. It was the long weekend. So what had happened on our end from what became GMEDD was we saw the settlement. And to me, this is a crystallization of where we can now lay out some clear paths where we think it will go. We know there's been a settlement. We know he's got 3 board seats. We know it's much more likely that he'll have more control. Fast forward 2 years, the board is 100% changed. It is 100% under his control as chairman. At the time, it was still uncertain, but we put out the report on, I think it was the 20th or 21st, after MLK Day. But I will say a big reason we did it was to counter program Andrew Left. And another big reason we did it was just to consolidate all the work that I and a handful of other shareholders have been doing, crowdsourcing research. For me, it was years. For some of them, it was months. But to kind of put it all in one place, these are where we think it could go. It could go here, here, or here. And I never ever would have expected that a week and a half after publishing that, the stock would get close to $500 per share, which at the time there was something like 65 million shares outstanding. So we're talking, GameStop in 2020 near the lows was a $250, $300 million company, and by the peak of that mania, it had gone more than 100x that. So it was an absolutely mind-boggling experience to be a part of.
I mean, I'm looking at these estimates of people predicting where GameStop's price would go, and you see like 78, 178, and you're saying like a week later it went to 500.
Right. So the bull case the GMEDD report we put out on Jan 20th was, I think on the bear case it was $32 pre-split again. Base was 80. In the bull case, we added a little memedom too, if you recall. We put it at 169.42. But the report had the depletion models, like for what sort of physical to digital mix we expected as the next console cycle came along. It had expectations on them shutting down a lot of stores, embracing an advertising technology business. So there's a lot of stuff that didn't happen, but there was a lot of real deep work that went into laying our logic out. And yeah, I mean, if you would have told me that a week later I'd be on the call with you with thousands and thousands of people, and then a couple days after that, Thursday morning when it made the all-time highs, I had the opportunity to participate in the Odd Lots podcast with Joe Weisenthal and Tracy Alloway. So we recorded it at 9 a.m. on that Thursday, Jan 28th. So during when it was making the all-time highs, I was recording this podcast, and it's just crazy to see. It's like what life was a meme at that point. I had a sell order of 420 shares fill at 420.69 while I was on my favorite podcast. Like you can't make this stuff up. It was crazy.
So you sold a lot of your shares, or some at the high, or would you?
My average exit. So I started to have shares called away from me that Friday going into the I call it mania week. I don't know what the technical term for that crazy week in January is, but that Friday the stock had been in the low 40s, mid 40s, and then who knows who or what just kind of forced the thing up. It closed up almost 50%. It closed up with all of the call options in the money that Friday, above 60. So I had like 800 of my shares called away at that point. My average exit across the entirety of getting out of my position was like $270-ish per share pre-split. So, it was a pretty good exit all in all, far better than I ever would have thought. But, my best sell was that 420.69 sell, which again, many people talked about that being a meme, right? And it's just astounding that it actually came to fruition and got there.
Did you get a lot of shit for selling when you sold?
Well, I posted on Reddit, which back then Wall Street Bets was a usable platform. It's, in my opinion, not really usable. It's not somewhere I invest any time and energy anymore. But I had posted that I'd exited and kind of explained some of my logic. It's unfortunate because my Twitter account, I hadn't really been using Twitter until COVID hit. I had set it up in undergrad though, so I'd never changed the password. So my account had gotten really popular, but by like early February, I wake up and I have like 6 emails from Twitter support, and somebody had gotten into the account. So whoever they were, they ended up trying to scam people. I knew a New York Times reporter through the whole kind of GameStop experience and reached out to him. And I'm like, hey, do you know anyone at Twitter? So he at least was able to get in contact with a human, because their automated support is useless. It was useless. Elon hasn't probably changed that. So I lost my account for a couple weeks in February, and the people who their IP showed Nigeria, they were trying to shill crypto. They deleted all my tweets, which kind of sucks because I had a lot of tweets about GameStop. But my stock twits posts are still there. My experience, writing Ryan Cohen a letter along the way on behalf of other retail shareholders, all that stuff, it happened. It was a crazy experience. It was my first real foray into anything resembling activism. Getting to kind of reach out to an activist and say, look, on behalf of me and 4% of shares outstanding, we support what you're doing. This was in December 2020 after he had sent a letter to the board in November, and it was the company had come out with its earnings results. It was a terrible earnings call. The utter low energy from the executives at the time who are no longer with the company. So to me, it was like after Ryan put his letter out, getting a sense that there could be another proxy fight. There had been one from Kurt Wolf's Hestia Capital in 2020. So sent him a letter in December saying, look, man, support what you put out in that letter, support what you're doing. If there's going to be another proxy fight, you have our votes. And he settled like 3 weeks after that. So presumably it helped, but it was wild experience to be a part of.
And right now, I'm showing the actual interview with Andrew Leff on. I don't know why I didn't say the date, but this is the live. If you could see in the thing, this is the chat. It was when it started to go crazy. Hold on, let's see the chat, how it's loading. This is when we had Andrew Leff on. We're going to do all these things to slow down the chat. You see GameStop to the moon, GameStop to the moon. I think it was at $60 here or something. But look at it. And they're calling, there it goes. Calls me boomer. And, and then we were forced to buying it because Jason Raznick, what the hell is up with and it was going crazy. Andrew Left's in full panic mode because someone crashed his Twitter. Bye, Jason. Like these guys were killing us if you see the chat because we didn't own the stock at the time. And then we bought it because if you look at let's look at this, show you on here. I don't know. The thumbs up, thumbs down. Well, it doesn't show the thumbs down now, but it was crazy how many negative people because we didn't own the stock yet. And so, Andrew Left's a fraud. And this was like the beginning of why does it show the date anywhere? I would love to see what the date was of this interview. January 21st, 2021. So was this, to when you did your report, when was your report?
I think it was the 20th.
The 20th? Really? Okay. So it was the day before this one? Okay. Got it. So this is the day he got hacked and was going crazy. And then, this was what's in that, that Netflix, Eating the Rich thing. And this is the thing. So then, so that was, okay. So I'm going to stop sharing that. And then
I'm going to shamelessly plug another doc. So the only one that I decided to participate in, which I did because a lot of the people who are part of the Roaring Kitty streams, which again, people who might have forgotten, Deep Fucking Value, DFV, the Redditor, is the same person as Keith Gill, who is Roaring Kitty. But nobody knew that until Christmas Day 2020 when he announced that he was Deep Fucking Value. So me and many others have participated in his Roaring Kitty streams from like August of 2020 through till December, sharing our research, discussion, monitoring company results, etc., and gotten to know him as Roaring Kitty. There was a couple dozen of us, and it was a nice little community. And the Rise of the Players documentary has me and some of the other members of that community and kind of hear the story from that lens. And I enjoyed kind of sharing that a little bit with folks and thought it turned out to be a pretty solid doc because I think what people forget who maybe start the story at January 21 is that, at least for me, there was years of being wrong on the investment where things had not played out well. I'll very briefly kind of summarize. The company went through a slew of CEOs. One of the CEOs passed away from brain cancer. They then had an interim CEO. Fast forward to like 2018, they decided to undergo a strategic review at the behest of Tiger Global Management. They then finish the strategic review in 2019. They sell off their kind of cell phone retail business, Spring Mobile. They bring in a bunch of cash. They then, further along in 2019, bring in the new CEO, George Sherman, the new leadership team kind of in that summertime. They zero out the dividend at the second quarter, I think it was, of 2019 earnings, and the stock just plummets. If you look at the stock chart from 2019, it's just god awful. It goes from like the mid-teens pre-split all the way down to like $3 and change. And separately from one another, in summer of 2019, that's when I know Keith Gill slash DFV slash Roaring Kitty began to accumulate his position. Michael Burry also in August of 2019 wrote a letter to the board encouraging them to accelerate the share repurchase program. I'd been on vacation in Hawaii on my mobile Schwab app buying January 21 call options when the stock got down to like $3 and change in August of 2019. So like all that happened in 2019, and then we had to go through all of 2020 with COVID hitting, the stores being closed, people being unsure if they'd survive. And then really the story then picks back up again in August 2020 when Cohen first got involved. And when he first got involved, the stock was still $4 per share pre-split. So it was still like a $300 million market cap company by August of 2020, excuse me. So just the pace of change from that point, when he began getting involved, to the 5 months to when it peaked was just, it felt like a second job to me. The amount of time and energy I poured into it, being part of sharing my research on StockTwits and Seeking Alpha and being part of all these discussions with him. So it's been a crazy time. And Benzinga, it was a blast to be on with you guys. And it was crazy to literally be on while the thing was, it was that Tuesday and the thing was halting every, few minutes, it seemed.
Yeah, I mean, this was an interview I did with Anthony Denier that was regarded like with the brokerage space. I know they had one on CBC with Vlad, but this was with the CEO.
Of Webull.
Webull.
There's a lot of misunderstanding by people about why the quote unquote buy button was removed. And it's really regrettable because I think a lot of it stems from Vlad being less than honest about what Robinhood was facing with the collateral kind of requirements that was, they could have failed, right? And I don't think he was honest. I think people think there's a lot of collusion of some manner that went on between him and Ken Griffin at Citadel. And I don't really believe that, but it's just sad to have seen a lot of people kind of take a very, I don't want to say warped, but their perception of markets was changed forever if they were a new market participant that got into this. And one of my things is this is not common, right? You don't see events like this in financial markets on a yearly basis, let alone, this is like a once in a decade type of a moment. And it kind of was the culmination of a lot of different things. We had a lot of stimulus, I think, payments that were hitting around that time. It was so easy for people to set up, their brokerage accounts at that time and fund them and add a lot of leverage through. A lot of people were trading options, I think, for the first time.
Yeah. And part of it, like, so when we had Denier on during this, he, like we were saying, I love his transparency, explained why they had the DTCC and what happened and the collateral wasn't there. And that's why they had to change how they were doing it. And he explained how the process worked. And, you can read the comments here. Cheers for being so transparent. I can now see the story and how it can be skewed negative, whether the sell button was disabled or enabled. Does not mean the community can't still hold the line, whatever. And Webull is now the app I respect. Let the hedge funds go bankrupt. They met getting anything does. Okay, so this was during this whole thing in the January 2022. I think Benzinga went live video for 18 hours straight. And we had Portnoy and Leary and just kept. Yeah, it was 2 days of 18 hours straight. I think we stopped at 11:30 each night, and it was absolutely insane. And that was that one, and then it was an interesting time and something that I don't know if ever will be repeated because I think markets change.
I sure hope not, because I feel like it would require that we have another pandemic. It would require that we have a lot of direct payments going out to consumers' pockets because the economy is being put on life support to an extent. It was definitely a moment in time that there will be books written about for many years to come.
Absolutely, and you were one of the key players in it that was getting a lot of attention and writing the research and putting color out there. And so, I guess a quick question I have, I don't know, give me the cliff notes. You mentioned that when you were in Hawaii, you bought some options at $3. So, how long before the craziness of 2021? Was it 2021 or 2020? I don't even know the year.
It was
How long
Jan
before?
21.
Okay, how long before that January 21 did you own the stock for?
So there's two answers to that. The fun fact is I've always been a nerd. I've always been interested in financial markets. It was like 2004 or so. I'm born in '89, so I was a teenager.
Okay, so you owned it in 2004?
Through my dad had set up custodial accounts for me and my siblings. I'm the oldest, and having gotten interested in that stuff throughout middle school and into early high school, I said I was a gamer too. I went to GameStop. We had like a GameStop, an electronics boutique, another GameStop in a strip by the mall by me, Funko Land.
Yep.
So I told him to buy GameStop, made some money off that, sold it before I went off to college. I graduated high school in 2007, so somewhere there. Fast forward to when I most recently got back in was late 2017. So it's really funny. I started with like 100 shares and continued to add to the position over the course of 2018, and really in 2019 was when I started to buy very, very aggressively. But I was down tens of thousands of dollars at points in time, and my net worth at the start of 2020 was like, let's call it $100,000. So I was down a lot of money for a long time, and I was very open to the risk that I was wrong. Part of my thesis was that we would successfully see them reach this new console cycle. By 2019, it was certain that the new consoles would have disk drives. That was a very big part of it.
Why is that a big part of it, the disk drives?
So for GameStop, they don't break it out anymore.
To buy the disc from there. Okay.
Right, but their business, as you probably know, is very driven by the pre-owned aspect. So if you don't have a used disc, from a software perspective, if it's a digital download, they don't have the opportunity to resell that 1, 2, 3, 4 times and slice some gross margin off that. That's been historically their highest gross profit percentage, as well as dollar driver for their business. So that's part of the reason why I think people like Melvin Capital and Co. had a view that it was a terminal zero, because I do see eventually that physical media is likely going to be gone. They won't sell new physical media. It's accretive for the publishers to sell digitally.
But you were owning it because you thought that with upgrade cycles, people are going to go to the store to buy, not just buy it online.
I thought, I guess the way I would characterize it is that the how deeply depressed the value had gotten relative to what I saw as their ability to generate cash over at least one more console cycle. It would be more like a cigar butt type view, right? I didn't think it was going to be a company that evolved into a winner over the long term. I think it's being priced that it won't even make it to this cycle. I think it will make it to this console cycle, the PS5, the Xbox Series X, and that it will generate meaningful cash. Cohen's involvement obviously changed the thinking and kind of opened up more upside optionality, which clearly the stock today already still bakes in a lot of that, despite the operating results not evolving as fast as I would have thought at that point in time. But yeah.
So you stayed in it, and then you were $100,000 in it, and that was, the stock was like at $20, or what was it at?
Well, at the start of 2020, it was at, I think, $5.50 or $6. It got down during March, when everything was selling off, to the high twos. That's when my current boss, John Kim, actually entered his position and opened his position. John bought, I think, a couple 100,000 shares at under $3. By the time,
so John spent $600,000 on it in early 2020.
Yeah.
And is that the average position size? Like he buys of stocks when he buys stocks?
No, I don't think so. I mean, I think I think we came to know one another later in the year, and I think his perspective was very similar to mine, that the math really didn't make sense if you had a view that they were going to get through to this console cycle. And we also recognized you can't ignore the reality that you had a larger number of shares short than were in the float. So, as we kind of said earlier, that Wednesday, the first day one of the big funds began to cover, the stock doubled from 19 to 38 or so. The week, I think it was like the 13th of January.
Are you talking? But wait, are you talking January 2021 now?
Yeah, yeah. Because there was that short interest for over a year, right? The stock had that level of short interest from late 2019, and part of the reason was that the new management team I talked about coming in 2019, they eliminated the dividend, but they did two kind of share repurchase programs that took shares outstanding down from a little over 100 million shares down to 65 million. So that automatically, by reducing the shares outstanding, raised the shares short, in the short interest meaningfully.
Yep.
And that remained elevated for all of 2020 and really into, the mania.
Yep, I get it, but I guess I've been screaming to everyone I know for the last few months about buying a stock called INMD. It's people are getting all the Ozempic, and this is
Okay.
if you have extra skin, you go to a medical spa, and they are one of those laser things that helps get rid of the extra skin from the Ozempic type stuff. And yes, the stock has taken off, and it forecasted higher sales, and they just had earnings day, and it's up, so it's 42%. And I went pretty big in the stock. I N as in Nancy, M as in Mary, D as in dog. I went pretty big in the stock, but I didn't go 500 big, but I went pretty big. And I guess my question is this guy bought it in early 2020. It doesn't do much for a year, it doesn't do much for a while. And then, it takes, whatever, it takes off a year from now. I guess the conviction to buy that kind of dollar amount in a high volatile stock is pretty impressive, unless John Kim that does this a lot, I guess, it's just really impressive.
John ended up by Jan 21 being, as far as we know, the largest external shareholder, largest retail shareholder. He owned,
besides Ryan Cohen.
Well, I guess at that point Ryan wouldn't really be considered a retail shareholder. I think he'd gotten onto the board, right? But yes,
Okay.
It was smaller than Ryan's position. Otherwise, it would have been disclosed, of course, on a 13D or G. But
Yep.
John also sold out of the position, and during that kind of mania week, and that capital, he owned a little less than 2% of the company. That capital enabled the formation of What Capital Management. So I work for him now. We'd become friends over the saga. We'd never met until Jan 2022. Interestingly enough, so it's crazy in this digital world that you can build these relationships with people, never meet them, get a hiring offer from someone you haven't met in person before, and go to work for them. But
That's the basis of Benzinga. A
Yeah.
lot of people that I've met, developers have heard me on video, and now work here.
that's awesome.
Yeah. So that's amazing. So what do you guys do now? What's your business now?
So it's a private investment fund. It's a family office. So a lot of what we experienced in GameStop, we are kind of hoping to create a platform that can enable that sort of crowdsourcing of knowledge, sharing of contrarian viewpoints, digging up of deep due diligence, nuggets of knowledge, whatever you want to call it, stuff that maybe you're not going to uncover just from reading the financial statements, and you're not going to have that insight just from reading a sell side report. So we saw that firsthand in GameStop. I might have mentioned it at the time to your audience that I was crowdsourcing order numbers. So their e-commerce platform had sequentially numbered orders. I found out by October, and with it being the new console launch, and with it being important to understand how well their e-commerce results were doing, I built kind of a little model that backed into what that implied for the business. So I was sharing that on StockTwits and Twitter freely. Just asking people to share their order numbers with me as they put them in. Even before that, just like, little nuggets of things, like somebody in a Seeking Alpha comment section making note of, oh, by the way, the lawyer that he hired is an M&A specialist. He is very well regarded. So little things like that made you kind of think, okay, he's very serious about where he's going to go with this campaign, right? The guy had put out a bunch of interviews
when you say,
talking about Cohen.
You're saying, okay, got it.
Yeah, talking about Cohen. So like it informed the view that it wasn't just like he didn't go to 9 point whatever percent just because he's going to sell out and move along. It seemed like he had a very serious plan to try to effectuate change, which obviously he ended up succeeding with the settlement. And fast forward to now, he's the chairman. It's his board. He's brought in hundreds of new employees. So I think that if you think long term, which is how I tend to try to operate, because it's really hard to ever know, right? Had no idea the craziness of January was going to happen, right? That was not part of my part of my thesis for getting into it, but over the long duration, like the stuff like that, bringing in the right people, refocusing on the right things, Chewy from a customer satisfaction perspective is one of the best companies out there. So I think people saw a lot of that and assumed that he'd be able to replicate some of that success in GameStop. But it takes a long time to do that. It's hard to change a business overnight.
Yeah, absolutely. And so we saw it play through in real time. Now I want to move on from GameStop to Playboy. You put out a report on Playboy. Let's pull up the symbol. Talk to me about Playboy.
So Playboy is another one.
What is it and why do you like it? Exactly. Yeah.
So I'll go back to what initially put it on my radar. They came back public via SPAC transaction in February of 2021. So just after the GameStop mania. One of the investors I'd befriended along the way with GameStop, he had sent me the presentation they'd done. I watched the video, and the simple question was, what do you think this brand is worth? And my response was, I think that brand is worth more than $1 billion. So it's a long story, and I don't want to go through all of the details. What I would encourage folks, if they're interested, we put out the report on Sunday. It's there's 3 documents. You can get to the report at PLBYDD.com. And the ticker is PLBY, so PLBYDD.com is the main report. There's an asset deck that's at assets.plbydd.com, and then there's a creator platform financial model at model.plbydd.com. The links are in the main report, which is plbydd.com. So why did we put this out?
We're sharing it up on the screen.
Okay. So I'd been on and spoken to you guys actually about it, and I think it was 2021, maybe it was 2022. But this is another one I've been completely wrong with regard to the price perspective, and I've been very wrong on the notion that the management team could operate any of these businesses. But where I don't think I'm wrong is I'm still quite confident that the licensing business, that brand, still has a lot more value than the market is ascribing to it today. And if you kind of go through the report, you'll see they actually own several other operating businesses. They have a handful of assets. They're actively selling multiple of the other operating businesses. So what ends up happening, right, is this the largest external shareholder, a company that I'd gotten to know called Builders Union, they owned about 8% of the company by year end 2022. When you're managing other people's money, you have this risk of a liquidation. The fund was liquidated, so that from like early February 9th to be precise, they were indiscriminately selling out of their entire position. So they fully exited. That took the price down. Furthermore, the stock was deleted from the Russell indices in June. So it's now been deleted from the indexes. Largest external shareholder just sold out utterly. They did a capital raise through a subscription rights offering earlier this year at $256. So there's a lot of moving parts. There's a lot of stuff that's happened. And to me, it was people still, to this day, they haven't published a magazine in over 3 years. And the first thing I see a lot of people respond is like, oh, who would buy a magazine anymore? And I'm like, you guys just don't understand at all what this business even is. So I really wanted to put the report out because it's kind of like we've gotten through all of what I think is the worst of it is in the past in terms of sentiment, selling, being removed from the indices. You now have, what happens next is, what do they sell these other assets that they have listed? Honey Birdette is a luxury lingerie brand that they bought in 2021. They paid a lot for it. They paid more than their current enterprise value today. But it still has value, and they have been actively shopping the business. I think they bring in potentially more than their current market cap in proceeds from selling the business. Another kind of little nuance, right? The balance sheet from the last quarter, which was March 31st, 2023, end date, doesn't reflect changes that happened after the quarter ended. They resolved their preferred stock situation. They rolled that into an amended and restated term loan. So like, there's so many things going on with this one, and it's been a clusterfuck along the way. And I've been calling for the CEO's resignation for just under a year now.
Which CEO?
Ben Cohen, the CEO of
But
Playboy.
then there's, yep, you're saying Ben Cohen, but I was just doing some research. So you've been calling. So we had Ben Cohen on our show.
Yep.
A couple times.
Yep.
And so then who is this? Is this the old one? Cohen Bernard?
That's his full name, Bernard.
Okay. Because I'm looking at the insider transactions, I guess.
Yep.
Okay,
So Ben is up for re-election at the 2024 annual general meeting, and I've made it clear that I believe he needs to resign. And while there's still a few months to finalize the plan, I would say right now, if nothing changes, he can expect to be going up against me for that board seat.
So you own a decent amount?
So it's my largest position in my personal account. I'm a beneficial owner of more than 0.5% of the company. And, we don't just put these reports out willy-nilly. I think this is only the second one I've ever done, of this nature. I think the hope is that we'll do more of these more frequently, but I guess my takeaway for people will be that it's gotten so extreme that I felt like I wanted to set the record straight, lay out what our viewpoint was on the prospective outcomes for the company. And yeah, look, there's only so much one can do, but in this case, he's up for re-election, as is Suhail Rizvi, the chairman of the board. And everything in my power will go to beating Ben Cohen and removing him. He is unfortunately a turd. He is weighing down everything to do with the company. Don't have anything good to say about him, unfortunately.
So let's say you were on the board. What would be something that you would change other than leadership? What would be something that you would change right away?
Well, first off, they need to consummate some of these asset sales and get their debt situation under control. The amount of interest that's going out the door annually is more than half of what they've kind of even guided to their pro forma adjusted EBITDA being. So the debt burden is just too high right now. They need to consummate some of these asset sales, which they've talked about for months, but we need to sign a deal. I don't care if you think the assets are worth more. This is the market you operate within. I think another thing that would be helpful is that they've done an okay job of trying to articulate the story that this is a brand that's not just for old men. And they've been rather successful in shifting their customer base. The customer base is now about half women and half men. It's a lot younger than it used to be. It's, I think, 2/3 of their kind of direct customers are under 34. So while it had in the past, when it was a magazine business, been old men, it's now younger. It's a lot more welcoming. They've definitely done some good outreach, I think, to the LGBT community, to women broadly. I think the creator platform they're working on has some prospective value, but they don't have the right operators there. that you have a private equity guy who has a private equity mindset, who, from my conversations with all the previous employees, with other investors, with creditors, with customers, everyone consistently says the same thing, that this guy is just has to go. So
I'm looking at the insider transactions. I'm seeing differing numbers. I got to double check with our team here, but I see on March 21st, 2023, Rizvi Sahil. I don't know if he purchased or if it was an options exercise. Do you know?
yeah, so
any...
I mentioned the subscription rights offering earlier. So Rizvi is the largest shareholder. His position had been down to around 20%. He oversubscribed in the rights offering and took his position up to just shy of 30%. There was a standstill agreement that he agreed to with the board, so he can't go past that. So he owns, and like the Form 4s may show it like just a little bit differently. It's him and his general manager, John Giampetroni.
Yep.
Combined, that's 30%. It might show.
But do you know if did they buy in March? Is that correct?
So it was the shares purchased from the rights offering, and then them kind of, I think the most recent one was them kind of shuffling the shares between entities, but still just shy of 30% ownership by him, Rizvi, and then Cohn's, at least on the proxy statement, inclusive of his options, is a little over 4%. So there's a lot of insider ownership by them. It's going to be very difficult to overcome that. But look, the latest proxy that happened about a month ago, if you do the math on it, the two directors that were up for election, if you exclude the insider votes, they lost by more than 2-1. So yes, those insider votes are meaningful, but it's very clear that the other investors in the company are opposed, and I'm going to do my best to get that energy aligned behind whatever we end up doing to oppose them.
I mean, because this stock was at $34, unless it was a weird transaction. Like, are you looking at the screen right now?
Yep, it was.
Can you see the $34 there?
I can. I remember.
And this is Ben Cohen, right?
I watched it.
You watched it on our okay. Yeah. So that's when we had Ben on the show. And it's just fallen. And I know the theme was less naked, other things, brand licensing.
What they did when they came back public with the transaction was they articulated this view that we are going to grow our direct-to-consumer, our owned and operated businesses. They did some M&A. They bought a cheap lingerie costume platform called Yandy in late 2019, yandy.com.
Right.
They then bought a mostly Western states sex shop chain called Lovers. Then I mentioned the Honey Burdette acquisition. So they did a lot of purchases of other businesses. But what we observed over the last year and a half is that they simply can't operate a lemonade stand. I don't think Ben could operate a lemonade stand. He'd probably forget to add the water, and it would just hand you a cup of sugar. They failed miserably in their owned and operated strategy. And basically, earlier this year, they did a complete 180 where they said, we're going to go asset light. We're going to sell off all these assets. So what's incredible to me is you have the leader of the failed strategy still at the helm. And that has been the message I've heard consistently, is many investors refuse to touch the stock until he's gone, because it's kind of like, how the hell could you fail so completely and not have any repercussions for it?
So
And I will say, I think the current strategy is the right one, to focus on asset light, focus on just the core royalty operation, sell off these businesses because you clearly can't operate them yourselves. But the challenge is when you sell all of that off, you're left with a very small core business that I don't think is large enough for public markets, which is why I don't believe that I'll even have the chance to go up against Mr. Cohen, because I don't think the company is public by the next AGM.
It's now the next, what'd you say?
By the annual general meeting. I don't believe it'll be public.
AGM, annual general meeting. See, we are our show. We try not to do abbreviations, but everyone knows what they are. But he said AGM. I didn't catch it. AGM, annual general meeting. All right. So it sounds like I got to get Ben on the show and see what he says in response.
You should do it. Let's see what he
I
has to
will.
say about how operations have gone and why
I
he should
will. I
remain
will.
the CEO. I'd love to hear that.
Yeah, I mean, there he goes. See, nice art painting here.
Yeah, we
I
included a valuation swag on the artwork collection in our asset deck. In
you did
2007,
okay.
they had talked about it being appraised at $20 million. So we kind of inflated the value based on CPI. We then did a discount. I don't know exactly the value of the art collection. They've talked about it a few times. In the latest earnings call, they noted it's going to be up for sale. I haven't really seen those sales yet, though, because maybe Ben doesn't
It's
know how
all
to
asked with
sell.
the art collection.
He knows how to
Also,
sell
the
those
art
shares, though.
collection. What'd you say?
He knows how to sell those shares. He has never made an open
Yeah,
market purchase, even though in the
I've
fourth quarter he noted how dislocated the share price was. So maybe you can ask him why he isn't buying shares if it's so dislocated.
yeah no, I will get him on and see what's going on. I'll try to do it next week or the week after.
Love it.
I gotta go back to doing the live thing, but yeah. So if you're listening to the Raz Report podcast, check out Wool Capital, WOOKCAPITAL, or for short, if you want to see the report, it's say PLBYDD.com. Correct?
That's right. Yeah. So remember, the
Yeah.
business is PLBY Group now, even though
Yep.
it's mostly Playboy's licensing business with the rabbit head and the brand
Yep.
name. And then these other businesses that I was alluding to, that many of which are already listed for sale.
Yep, absolutely. So, yeah, I mean, Rod Alzmann does, research and has been involved with different companies. And like you said, I asked him when he bought his GameStop first, and he heard the two answers because he goes, I was a nerd. I'm a nerd. No, I am a
I
nerd.
still am. I'm proudly a
Yeah,
nerd.
we all are nerds. Come on. But it's heavy due diligence, and I will work on getting Ben Cohen on the show. I've had him on a couple times, or Benzinga did. This one's a little bit different. This is our Raz report, but we go way back. I mean, Rod was GME DD before anything, which is I mean, how many people at one time were like on your email newsletter list for GMEDD? Did you
Oh,
have
and
that?
look, we still have the Discord community has a little less than I think 10,000 people in it. So people can join the Discord server. We talk about all variety of stocks. It's certainly not just GameStop, but it is like the desire is not to find a stock that because look, like I said, I have no clue what stock prices are going to do in the short term. My ideal situation is to find something where it is just utterly hated. Everyone thinks it's dead. Everyone doesn't like it. I am uncomfortable when people like a stock that I like. I much
Hmm.
prefer what GameStop was. It was completely disregarded and discarded and left as dead and left as trash. But then, of course, on the tail end, it went up 100x, and now the forward return profile was unattractive. It still is unattractive in my view, and people fall in love with stocks, and you really shouldn't, because the stock's not going to love you back. The stock doesn't care about when you bought it or when you sold it. To me, what's important is what do I think the forward return profile looks like for this security, and it's often going to take years if it's something that's deeply disliked. So it's more of a contrarian, value-oriented mindset. And I think, though, that's where getting deep insights, whether it's an industry insight, thinking about the consoles, whether it's knowing more than you would otherwise glean just from financial statements. I think you need that, and I think in today's world, with our ability to connect with people globally instantaneously, it's incredible how quickly information travels. And I'm certainly not a subscriber to the efficient market hypothesis.
Yep, I believe like Benzinga and why I started. There's opportunities everywhere. There's market asymmetry. One reason I started Benzinga was that small cap stocks weren't covered by mainstream media,
And
and I
that's
was
where
good at
you're
finding.
usually going to find the opportunities because you don't have enough
Yep,
eyeballs on it.
and that was exactly what I did in the defense sector. after 9/11. There was a company called Envision, INVN, and it was a public company, and it made the security, like all types of things. And my INMD play was all a COVID, not COVID. It was all about this Ozempic. It's not Ozempic, but it's like the thing. It's up 40% since then. But it's finding those asymmetries where you can find the expert. And yes, if Mr. Market goes down a substantial amount, then it's nothing you can do most of the time. But over time, like you said, you can be rewarded in a asymmetric way. And, some of these things are binary. Some of these things, win or lose. But if you make the right bets, your GameStop is a once in a lifetime, I think. But yeah, who knows, I guess.
It'd be nice to find another one like that, but yeah, it's definitely a risk too. If you're a younger investor and you experience some sort of windfall profit, like to try and tether yourself to the reality that was an outlier event, and they're not going to all be home runs, and you don't need to be chasing that high. Because I know a lot of people who made a lot of money in that, and then they really were like spending 2021 the balance of the year and 22 like trying to chase other things, and ended up burning a lot of their profits or all of their profits. So, investing is a really tough game. It's very emotionally demanding, especially if you're like me and you come on these discussions with people like Jason, and you're talking about stocks. Because look, PLBY, if the stock goes up a lot, I'm not going to be married to it because the forward returns are going to now be smaller, and I'll adjust my position accordingly. So. I think you have to be guided by a view on here's where this exists today based on everything and understand about the range of prospective outcomes. What is the likelihood that you have upside versus the downside, that sort of stuff. And people have to all make those decisions themselves. But I do think it's all in all, it's good to kind of talk about and hear different people's opinions on things. Hopefully they're informed opinions and not just noise to kind of help you and improve your overall process.
Yeah, that's the name of the game. And to try to get an edge where it's not there. And then do you lose conviction? Like I have a stock HubSpot that was going down, and I didn't lose conviction because everyone I talked to who had small businesses were moving to HubSpot from Salesforce. And I'm like, no brainer. I tried to get the Salesforce CEO to buy HubSpot when it was like at $60, and now it's at $556. But you're not going to always have the deep conviction. Like you said, you haven't put out one of these reports since GameStop. So it's when you have these deep convictions is when you make a stand and try to put out that viewpoint. And it'll be interesting when you run for the board. Maybe we'll have you on again and tell your side why you should be on that board.
Yeah, I look forward to hearing their next earnings, which you'll probably have to wait till that comes out to see about having Ben back on, which should be in a couple weeks here. They haven't yet announced it, but it should be in early August. And that'll be their second quarter result. We'll hear if any assets have been sold, and depending on what I hear from Ben, we'll decide to take next steps. So,
got it. Okay. Well, stay in touch with us then. I'll see what I can do about bringing him on, and to stay in touch with us, and we'll go from there. I appreciate catching up. It was good to talk about the GameStop stuff. Thanks for coming on the Raz Report. If you have any other cool stories or angles, or I don't know, maybe not even stock market related, please let me know. You're a friend of Benzinga and been for many years, and appreciate you and the amazing transparency that you provide throughout this. So thank you. Rod Alzmann, you can reach him on, you can see his report on PLBY. Or on the PLBY.DD for the report, and Woke Capital, or on Twitter, Rod Alzmann, spelled ALZMANN, and Raz Report. You know where to find us. Benzinga. Hope to see you guys we're doing a big fintech show in November. I don't know the date, but it's in November. We're gonna have everyone and anyone there. So if you're around, come check it out. Any of the listeners. But that's it for now. Look forward to having you on again soon, Rod. Thank you.
Thank you, Jason. Appreciate it.